The trend is the greatest mystery all traders want to solve, but it's not that easy, and a plain definition of a trend is not enough. In this video, we're going to show you how a trend could be up, down, and sideways at the same time. And that's why one of our favorite trading strategies is the dual frame trading strategy. I hope you guys benefit from this lesson, and if you do, please like the video and subscribe to receive more valuable lessons like this one.
The top indicators are trend following indicators. That means that they only work when the market is trending. Otherwise, they will give you false signals. Therefore, it is of vital importance that the trader first identify the trend. But here is an important challenge we have to make you aware of. The trend of any market is usually up, down, and sideways at the same time, depending on what time frame you use. While the trend in a daily chart may be up, if you looked at a 4-hour chart, it may be sideways, but clearly down in a shorter time frame. Let's examine this in more detail as you become familiar with the key subject for our DFTS strategy. For example, this is a daily chart of the euro. The downtrend line clearly defines this trend as down. So does the slope of the moving average. However, at the very same time, the trend is sideways on a smaller time frame. On this 4-hour chart, you can clearly see the trend lines converging. That's a typical sign for triangles, the most obvious expression of a sideways market. The moving average also flattened in the latest part of the chart. And as you already have learned, that is a sign of a market that is in consolidation process. Once we move to a smaller time frame, in this case we are using a 15-minute chart, then we can see a clear uptrend defined by the 45-degree uptrend line and the slope of the moving average. These three charts of the same market viewed at the very same time show three different trends. The daily chart is in a downtrend. The 4-hour chart is in a sideways trend, and the 15-minute chart is in a clear uptrend. So what trend should we consider at the time of taking our trade decision? We need a clear system that allows us to handle all this conflicting trend information. And that's precisely the reason why we created the dual frame trading strategy. We have observed that every time frame best relates to a larger or shorter time frame by a factor of 5. This is approximate, but it works very well for our trade setup. That means that if you want to scalp using a small time frame, you would use a larger time frame to identify the trend and determine the direction you're going to trade. We call this larger time frame the reference frame, or RF. The shorter time frame is called TC, which stands for the trigger chart. If your lower time frame or trigger chart is 5 minutes, your reference frame should be 25 minutes. Obviously, if you are a swing trader who prefers to keep positions overnight, you will need to adjust these time frames to 60 for your trigger chart and 300 minutes as your reference frame. So for our dual frame trading strategy, we will combine two time frames related by a factor of 5. We will be taking our trades from the shorter time frame. We call it trigger chart, for it is here where the trade signals will be triggered and executed. Let's assume that you typically hold positions for less than an hour and use time-based charts. So we recommend you use the combination of 5 minutes as a trigger chart and 25 minutes as your reference frame. This dual combination can be very useful because it allows for quick scalps as well as small swings. The larger reference frame, in this case the 25-minute chart, will be used solely to identify the trend and determine the direction in which we are going to trade. That means that if the trend is up on the reference frame, declines on the 5-minute chart will create buying opportunities. If the trend in the 25-minute chart is down, 5-minute rallies will allow us to shorten the market when the top indicator gives us a signal to sell. And this is key. In fact, it is the most important filter to use with top and at the same time, it is also the one most often neglected. So take notes and never ignore this key issue. If the trend is up on your reference time frame, declines on your trigger chart will be used to buy the market. The timing of your entries will be determined with the help of the top indicator buy signals or any timing tool you use. The most important thing is that if the trend is up in the reference frame, you use the declines on your trigger chart. If the trend is down on your reference time frame, rallies on your trigger chart will be used to sell the market with the help of the top sell signals or any other timing tool you're accustomed to. Here's an example of a downtrend in the ES. For this example, I'm using a combination appropriate for swing traders. So as a reference frame, I'm using a 300-minute chart. As you probably remember, the sole purpose of the reference frame is to help us identify the trend and the direction in which we are going to trade. In this example, the slope of the moving average has changed from up to down, and we get a close below the moving average. For all intent and purposes, this defines the trend is down. So what should we do after we see the first close below the moving average that is already pointing down? The first step to identify the trend has already been done. The trend is down and we got a close below the moving average. Our job now is to switch our attention to the trigger chart, which in this case, respecting the factor of the relation by 5, is the 60-minute lower time frame. If we were scalping using time-based charts, we would use a 5 minutes combined with a 25 minutes as a reference frame. That's our dual chart trend system. The reason why I mention the time-based charts is because, in our experience, it is not convenient for scalpers to use time-based charts. We'll discuss this better in another lesson. Since the trigger chart is the one from which we would be taking and executing our trade signals, it is the only chart on this chart we would be placing the timing indicators we intend to use. The reference frame does not need anything else than the 30 weighted moving average. This is the lower time frame, our trigger chart with the top indicators on. Notice how the first 3 sell signals were invalid. Why? Because they occurred before prices closed below the moving average in the reference frame. So for us, at that point, the trend was still up. In order for us to consider that the trend had changed, we needed to see a close below a downslope moving average. The real valid signals occurred in the middle of the chart. It was then that we had our first 2 conditions for a valid trade. 1. The trend was confirmed as down by the reference frame. That was done via the closing below the downslope of the moving average. And 2. We had a rally in the trigger chart allowing us to take top sell signals. While prices stay below the 30-period moving average in the reference frame, every rally in the trigger chart should be considered as a sell opportunity. But you can see one sell signal that I didn't consider as valid. It is the one in the middle of the chart where I drew a circle. That signal did not work. The question is, was that a valid signal? The answer is no. We will clarify why that signal should have been ignored in the next videos. We will discuss how to properly identify the direction of our next possible trade and what constitutes a valid buy or sell signal using the top indicators.